Hello, everyone. It's Professor Reiko here again. We're continuing on through the investment chapter. Our last handful of videos all focused on debt investments, and now I'm switching gears to talk about equity investments. So this is us buying stock of other companies. So if we look up here, we see equity securities represent ownership interests such as common, preferred, or other capital stock. And typically, I just kind of lump it all in as common stock for the sake of making things easy in the examples. All right, so the cost of equity securities includes the purchase price, meaning what we bought the stock for, as well as any commissions or fees associated with the purchase price. So if you've done any individual investing, you know there are certain accounts that charge you a trading fee every time you make a trade. That fee gets lumped into your cost basis of the stock, and it's no different here. All right, so keep that in mind. If you have a question on the test or multiple choice question and there's a commission, make sure you add that into the cost of the investment. All right, so there's I guess there's three main categories, two that we're going to talk about or focus on about accounting for it. So if you remember back to the debt investments, we had held to maturity, available for sale, and trading. So there was three categories. So here it's kind of a similar setup. All right, so if we hold less than 20% of the total stock of the company, we have a passive interest, and we use the fair value. Okay, this is also called the fair value through net income method, and that just means that the unrealized holding gains and losses are going to be recognized in net income. Okay, so this is like the trading securities from the debt investment portion. All right, because remember we recognize those as well. So this accounting for these are going to be similar to the debt investments, and I guess it says it right there, similar to the debt investments classified as trading securities, meaning we are going to value them at fair value. So every balance sheet date, we are going to adjust them up or down to their fair value. How do we do that? We do that by Part B, recognize the unrealized holding gains or losses and the fair value adjustment for the investment, whether it's going up or down. Part C is what do we do with kind of the income and realized gains and losses. All right, so with bonds, we had interest revenue. Now we have dividend revenue. So when we receive dividend revenue, we're just going to record it as dividend revenue. And then we're going to recognize a realized gain or loss when it's sold. All right, if we hold between 20 and 50%, and this is important, and have significant influence, we'll talk about that when we get there, we use what we call the equity method. Okay, so we're going to value using the equity method, and we'll talk about that in detail when we get to that video. There are unrealized holding gains and losses are not recognized, meaning we do not adjust to fair market value. So we'll talk about that as well when we get there. And then we are going to recognize our proportionate share of the changes in the investee's net assets. And that's how we're going to increase or decrease our investment. So we'll talk about all that when we get to the equity method. Okay, I think the equity method is actually the easiest part of the chapter because every single journal entry has a debit or a credit to the investment, and it just makes life a little bit easier. All right, if we hold more than 50%, we consolidate. Okay, so most, they talks a little bit about consolidations in the intermediate textbooks, but most of those typically are hit in an advanced accounting class, so we're not really going to talk about consolidations here. All right. So just remember that with debt investments, the unrealized gains and losses were calculated by comparing the fair value to the amortized cost. So remember, the amortized cost was the far right-hand column of the amortization table. So we would take the fair value compared to that number, and then we would recognize an unrealized gain or loss for the increase or decrease depending on which direction it went. All right, so equity investments are a little bit easier. It's because there's no amortization table, all right? Because we're not amortizing something back to its face value, and there's no set life on it. Remember, bonds have a set life. Theoretically, stock can exist forever unless the company goes out of business. All right, so the fair value of the investment will be compared to the original cost, or put note here, or updated cost if we buy some or sell some. Okay, to determine the unrealized gains or losses. So that makes life a little easier because we're not doing an amortization table. We're just always going back, grabbing the original cost number, and then comparing that to the updated fair value to see if it's gone up or down in value. So it's a little bit quicker, a little bit easier because we don't have the amortization table. We're not recognizing semi-annual interest and amortizing discounts or premiums and things like that. So we'll see some similarities, especially when we look at the fair value method as comparing to the trading securities on the debt side. and then the equity method will be something new and a little bit different. All right, so that's just a brief introduction to what we're about to do together over the next 3, 4, 5 lessons. All right, so make sure you tune in to the next one, and we'll start walking through that first, the fair value through net income method, and walk through some examples and then lead into the equity method after that. All right, hope you're enjoying them. Please share with your friends and subscribe to the channel. I appreciate everyone tuning in, and hope you tune into the next video. Thanks.